If you're one of the millions of people who manages their investments on a smartphone, you've probably seen it.
Oh, for sure.
You make a trade, and this cascade of virtual confetti just explodes on your screen.
Right. Or you get that leaderboard, that little nudge to see how your portfolio stacks up against others.
These aren't just random design choices, they're very deliberate.
Not at all. These features, the sounds, the colors, the instant feedback, it's all part of what we call gamified trading.
Yeah.
It takes this really intimidating world of finance and makes it feel like a game.
But that's where the problem starts, right? That feeling of a game comes with a pretty serious conflict of interest. So today we're going to do a deep dive into the source material here, pulling from major reports by the CFA Institute and some really sharp legal analysis from the Yale Law Journal.
Mm-hmm.
Our mission is to really understand the design choices, the psychological impact on us as investors, and of course the big regulatory battle that's brewing.
And the core question we have to ask is this. Gamification has made investing way more accessible, which is great, but does that design, actually lead you toward riskier behavior?
Behavior that benefits the platform more than it benefits you.
Precisely. We need to unpack how these apps keep you trading and, who really profits when you act on impulse.
Okay, let's start right there with the business model. When we say gamification in trading, what are the specific features the sources point to? What are we actually talking about?
Well, the CFA Institute report is pretty clear on this. It points to things like those instant visual rewards, the confetti we mentioned, which give you this immediate positive feedback for taking an action.
A little dopamine hit.
Exactly. Then there's stuff like randomized prize stocks for referring a friend. That taps into our love of a lottery, of an unexpected reward. And then you add in the constant, colorful push notifications, the leaderboards. It's all designed to drive engagement.
So it's about making financial planning feel more like a competitive mobile game.
That's the goal.
But, and this is the key economic question, why do brokers need all this trading volume so badly? I mean, most of them are commission-free now.
And that's the absolute heart of the issue. The zero commission model completely flipped the script. The broker's profit no longer comes from charging you for a trade. It comes from maximizing how often you trade. And that's all because of something called payment for order flow.
PFOF.
PFOF, yes.
Can we break that down for a second? For the listener, what's better for the broker? One big $10,000 trade or 10 smaller $1,000 trade?
Oh, it's the 10 smaller trades, hands down. It's not even close.
Why?
Because with PFOF, brokers route your orders to big third-party market makers, like high-frequency trading firms. Those firms pay the broker a tiny fraction of a cent for every single share in that order. So more orders, more individual transactions means more revenue.
So every design element is just a tool to get you to press that buy or sell button one more time.
Exactly, because 10 instances of order flow generate way more revenue than just one.
Okay, so if the goal is just pure volume, the conversation really shifts from economics to, well, psychology. How are these design choices tapping into our mental weak spots, I guess, to guarantee that volume?
This is where it gets really calculated. I mean, the design is almost meticulously engineered to bypass the rational part of your brain, your prefrontal cortex, and appeal directly to impulse.
So what behavioral tendencies are we talking about here?
The research really points to two big ones. First, our desire for immediate gratification.
The confetti again.
The confetti, the instant rewards. They short-circuit the patient, long-term thinking that good investing requires. It's replaced with a system that rewards you for acting now.
And the second one?
The second is loss aversion. The psychological fact that the pain of losing $100 feels twice as bad as the pleasure of gaining $100.
Right.
So the constant notifications, the fear of missing out, it all encourages you to jump back in, maybe take a riskier position to try and make back a loss. And all of that just generates more trades for the platform.
The CFA report says it pretty bluntly. It says, when apps emphasize social status and these game-like rewards, they are actively nudging you toward emotional choices, not choices aimed at your financial security.
It's a huge conflict. You can even call it a principal-agent conflict. Gamification can be used, well, deceptively, to steer you towards outcomes that are profitable for the app, not for you. And we can see the impact.
How so?
The data shows that these game-like features are directly correlated with more trading in, popular, riskier stocks. Think about the meme stock frenzy in 2021.
That feels like the perfect example, which brings us to a huge legal question raised in that Yale Law Journal essay. If these flashy graphics and surprise rewards encourage impulsive trading that directly profits the broker, Shouldn't they have a fiduciary duty to limit those practices?
That is the highest stakes question in this whole deep dive. A fiduciary duty means you have to put your client's interest above your own. And if your platform is basically designed to profit from your client's impulses or their mistakes,
Yeah.
well, it throws real doubt on whether you're acting in their best interest at all.
So the argument is that the design itself is a form of recommendation that should be regulated.
That's the argument.
Yeah.
That it should be held to a much higher standard.
So are regulators like the SEC and FINRA catching on to this?
They are, definitely. They recognize that the old rules about just disclosing information don't really work when you're talking about psychological nudges. The SEC has actually put out a request for information on what it calls digital engagement practices.
They're trying to figure out how the old rules even apply here.
Exactly. And FINRA, which is the industry's self-regulator, is focused on this too.
What are they doing?
They're scrutinizing any app that uses these interactive or game-like features. They're worried these features might lead investors to misunderstand risk or just trade way too much. The focus has really shifted.
From just checking for disclosures to what?
To asking if the user experience itself is fundamentally undermining an investor's ability to be rational.
So, okay, what's the fix? The CFA Institute seems careful not to call for an outright ban.
No, and that's because gamification has also driven a lot of innovation and access, which is a good thing. They argue for something called principles-based regulation.
Meaning what, exactly?
It means setting high-level standards for ethical design, instead of writing a bunch of specific rules that will be outdated in a year. They have a few key ideas. One is to deliberately add friction back into the system.
Friction, so just slowing things down.
Exactly. Force a moment of reflection. This could mean requiring, say, a mandatory review step before you execute a really high-risk trade. Anything to interrupt that impulse loop.
Let the rational brain catch up.
Precisely. Another big idea is to redesign the reward systems. Instead of celebrating every trade, reward long-term outcomes.
Like what? Holding a diversified portfolio for a year.
That's a great example. Or meeting a savings goal. You shift the reward from the action to the responsible outcome. And of course, the third piece is transparency.
Especially when social media gets involved.
Oh, transparency is paramount there. The platform should be steering you toward reputable third-party research, not just showing you hyped-up info within the app. And there needs to be total clarity if social media influencers are being paid.
That's a perfect transition because that social layer is maybe the wildest part of this whole thing. We're seeing the rise of copy trading platforms.
Where you can just automatically copy the trades of a so-called popular investor.
Yeah, what are the risks there?
Massive conflicts of interest. That popular investor you're copying might be getting paid by the platform or a third party. You'd have no idea. They make money as long as you keep trading, whether you win or lose.
And it also just opens the door for pure deception, not just bad advice. What do the reports say about that?
They warn about engineered social proof. Bad actors can use fake accounts, bots, to make a stock look way more popular than it is.
A pump and dump scheme.
A classic pump and dump. They can even use bots to trade back and forth with each other to create the illusion of high volume, tricking novice investors into buying in right before they sell. Relying on that kind of social media advice is incredibly risky.
Which makes regulating influencers so critical. Are regulators actually looking at that group?
They are. They know that a lot of financial advice is now being delivered on TikTok, not from a licensed broker. So they're seriously considering things like mandated disclosure rules for influencers.
So if you tell someone what to buy, you have to say who's paying you.
Exactly. And maybe even licensing requirements if the advice they're giving crosses a certain line into a formal recommendation. So if we pull all these threads together, I think the key takeaway for you, the listener, is to see the two sides of gamification. On one hand, it's been a huge success at bringing more people into the market. That's a good thing.
But on the other hand,
the design is fundamentally built to maximize your trading activity. And all the research shows that often conflicts with the patience you need for long-term financial success. So being vigilant about these behavioral nudges and hidden conflicts, it's not optional anymore, it's essential.
absolutely. The whole regulatory conversation we've been having seems to be about adding that friction back in, right? Finding ethical ways to create moments for reflection. So let me leave you with a final thought, building right off that idea. If we know that even a brief pause can stop an impulsive, risky trade that is pure profit for the broker, should platforms be legally required to introduce, say, a minimum 60-second cool-down period before